There's a massive shift in global power happening right now, but it's not on some battlefield. It's taking place quietly, in the world's busiest ports. Today, we're diving into China's strategy to control the very gateways of global trade, and what that really means for all of us. Let's get into it.
Okay, to really get what we're talking about, you have to start with this number. Over 80%. That's how much of all global trade moves by sea. We're talking about everything from the smartphone in your pocket to the coffee in your mug. So you can imagine whoever has influence over these sea routes, well, they have a huge say over the entire global economy.
And that really brings us to the big question, doesn't it? For the last decade or so, China has been on this incredible global spending spree, investing in ports everywhere, from Europe to Africa to Latin America. So what's the deal? Is this just smart business, or is there a much bigger game being played here?
All right, so first things first, let's just try to wrap our heads around the sheer scale of this. This is not about a few random deals here and there. Nope, we're talking about a systematic, decade-long investment strategy that has put Chinese companies right at the helm of some of the most strategic ports on the planet.
And the ones behind this? They're not just any companies. We're talking about massive, state-owned giants, mainly Costco Shipping and China Merchants Port. And the fact that they're state-owned, that's absolutely crucial. It means their corporate goals are directly in line with Beijing's national strategy. And their reach, it's gone global, creating this incredible network that crisscrosses the world's most critical shipping lanes. Okay, but here's something we need to get straight right away. When we say China is buying ports, it's usually not about actually owning the land. What's really happening is that these companies are getting their hands on long-term operating leases. And when I say long-term, I mean it. We're talking 30, 50, even 99 years. That gives them control over pretty much everything, the day-to-day operations, the logistics, basically the port's future for generations.
So why? What's driving this multi-billion-dollar strategy? Well, the first and maybe most straightforward reason is pure economics. You could almost think of this whole global network of ports as one giant insurance policy for the world's second biggest economy.
I mean, think about it. China's entire economic engine is built on trade. It's the world's factory, right? It ships out tons of finished goods, but it also has to bring in massive amounts of energy and raw materials just to keep the lights on. Any little hiccup in that flow of ships could be absolutely devastating for its economy.
So what this really boils down to is security. By controlling this web of ports, Beijing can make sure its supply lines stay open, no matter what's going on in the world. Geopolitical tensions, sanctions, you name it. It's a really powerful way to insulate its economy from pressure from the outside. But wait, it's not just about playing defense. The second piece of the puzzle is all about offense. It's about moving from being just another participant in global trade to becoming a real power broker, someone who can actually shape the rules of the game. And this is how that power starts to build. See, when you run a port, you're doing way more than just moving boxes around. You gain control over the logistics. You get to influence how and when containers move. You help set the tech standards for the whole facility. And eventually, you can weave all these different global routes into your own commercial network. It's kind of like giving yourself a home field advantage on a global scale.
And this, right here, is where things get really controversial. This is the third motive, and it's the one everyone's arguing about: how these commercial assets can turn into real geopolitical power.
Let's take a look at the Hambantota port in Sri Lanka. It's pretty much the poster child for this whole debate. The story goes like this. Sri Lanka had a hard time repaying the Chinese loans it took out to build the port. So what happened? It ended up leasing the port to a Chinese company for 99 years. Critics immediately pointed to this as a classic case of debt trap diplomacy, the idea of using debt to get your hands on strategic assets. China, for its part, says, hold on, this was just a commercial deal to make a failing port profitable.
But then you've got the port of Piraeus in Greece, which tells a different story, or maybe two stories at once. On the one hand, Chinese investment was a huge win. It took a struggling port and turned it into one of the busiest hubs in the Mediterranean. But on the flip side, people worry it gives Beijing a ton of economic sway over a key European country. It really shows you the two sides of the coin with these deals.
Okay, so all of this brings up a huge concern for Western nations, and it's this idea of dual use.
So what does that mean? Well, the fear is pretty straightforward. Could a commercial port today become a military launch pad tomorrow? We're talking about facilities in incredibly strategic locations. So for rival powers, the worry is that these ports could be used to support military operations in a crisis. Now, to be clear, there's no hard proof of this happening yet, but just the potential for that kind of access is enough to make a lot of people very nervous.
So you can see why for the countries signing these deals, it's a massive trade-off, right? On the one hand, they get infrastructure they desperately need, and they get it fast. Plus, the money often comes with fewer political strings attached than what they might get from the West. But the downside? The risk is taking on huge long-term debt and potentially becoming economically dependent on Beijing.
All right, let's pull back for a second and connect all these pieces. When you put the economic insurance, the supply chain control, and the geopolitical leverage all together, the picture that starts to form is way more than just a bunch of business deals. It's almost like the outline of a new global map being drawn for the 21st century.
It all boils down to a few fundamental truths about power. First, and this is a big one, infrastructure creates influence. It's simple. Whoever builds the world's roads, railways, and ports will always have influence over the people and economies that rely on them. And that influence, it naturally becomes leverage. If you control the physical flow of goods, the actual nuts and bolts of the global supply chain, you have a seriously powerful bargaining chip you can use in almost any international negotiation.
And what does all that add up to? It's about the long game. Shaping the world's most vital trade routes isn't about next quarter's profits. It's about building a strategic advantage that's designed to last for decades, maybe even a whole century.
So we kind of end up back where we started. Is this just a really savvy business strategy to protect the world's factory? Or is it a quiet, long-term master plan to reshape global power by controlling its arteries? The truth is probably a complicated mix of both, but as this new map keeps taking shape, just understanding the question itself is more important than ever.